Thank you very much all for not leaving after the last one. So we have an incredibly exciting panel here today. We're going to talk about the question of exits and when you should stay, when you should go, when you should raise, when you should do M&A. And we have really an amazing set of people who can give us some real insights about this. So we have on the far end, we have Antoine Martin from ZENLY, which was sold to Snap 2 years ago. And it's very excited to have him here because I believe he has not spoken about this since.
Thanks for having me.
So this is a scoop, as it were. We also have Sonali de Rycker from ACCEL, who is going to give us the kind of investor perspective on this issue. She's been involved in numerous big exits, such as Avito. And then, closest to me, we have Magnus Nilsson, the executive chairman of IZETTLE, which was heading for an IPO last year, and at the last minute got sold to PayPal. So we have people here who really understand this issue, have an amazing perspective on it. And I'm going to start, seeing as it's the big scoop, as it were. I'm going to start by asking Antoine just to tell us a little bit about how the Snap deal came together. Was it something you were looking for, why you went for it in the end? But can you spin a little tale for us? Because this hasn't been told before, and it's very interesting.
Sure, thanks for having me. So we never would have thought that we'd join a company this early. We had always seen ourselves as very independent and looking forward to continuing that. What happened is we were lucky to meet Evan Spiegel, the CEO and founder, co-founder of Snap, a year before the acquisition. Very fast, we clicked. 5 minutes after the first meeting, we were showing each other prototypes of things he was building on the Snapchat side and things we were building on the ZENLY side. Realized over time, as during a year of meetings, that our visions were fairly similar on what was doable in terms of social maps, and that the DNA that both companies had were close enough to try to do something and go further with an ally like Evan. We had, of course, a lot of interest from various companies, one of which where we felt our moral or our ethics could not be guaranteed, so we chose to join Evan. He became very convincing, and it's been a honeymoon since. It's been 2 years. We totally stand by the decision. We're probably 20 times bigger than we were back then. So it's very happy with the way it's been going.
A lot of us in this room should be so lucky to ever be in this position. But if we ever were, what advice would you give people? What did you do right? What did you do wrong? What would you do differently? What are the kind of learnings, as it were, that you would share with the audience from what happened?
It's of course very specific to each company, but in our case, what I think changes everything is having the sponsorship of someone that can give us the right to say no, and that is very convinced in our approach to date, has been pushing us to continue it. And so is more of a sponsor than trying to guide us to a direction he believes in. I think that's the thing that worked out for us. We also were in a situation where we didn't have to sell the company. We were growing very, very fast, had a lot of funding. So it was a real decision to try to maximize ZENLY's chances of success, and it's been true.
Magnus, you were going for an IPO, and it was all looking so sunny and fine, and then all of a sudden, you picked a different track. Why did that happen, and what were the kind of lessons you learned from over the last? I mean, it's still early days, right? But from that deal with PayPal.
Well, I think we planned for an IPO starting already in 2016, and that meant that we made a lot of changes to the company, primarily making sure that Jacob and I, my co-founder and I, were not, you know, the bottlenecks of the company in a way. So in that process, we sort of had a lot of partnerships going. We knew PayPal from before. But really, the road towards IPO was set, and we had discussions, should this be dual track or not, and we decided not. We're going to go public, and that's it. And we were ready for that size-wise as a company. And then, you know, very late, 4 weeks prior, funnily enough, today is exactly 1 year ago that we signed the agreement with PayPal. So, but you know, that was an intense 4-week period that that ended up with us signing just before midnight on the 17th last year, and on the 18th, which was a Friday, we were going to go public and start presenting our prospectus to investors. So, very intense period. But I think the most important part that convinced Jacob and me to do this was a cultural fit, a similar vision about supporting small businesses around the world, democratizing financial services, all those elements that we had been sort of, you know, talking about for years. We found a company much larger than IZETTLE, having the exact same language, and the exact same language among the different executives in the company. That was incredibly important to us.
How did you know they weren't just going to turn around and say, oh, great, you know, everyone, we're going to chuck everyone out and you're going to become a lettuce delivery company, you know, they were going to completely change strategy?
Well, you don't know that, you know, and to buy a company is very risky, you know, so you have to make sure that you really understand what you're about, you know, but to me, so you meet with the management team, and of course they're people. They can be there and they cannot be there. You don't know that, but so I think it's to look at their history, what they've done before. PayPal is very acquisitive in buying companies. They have officially stated, you know, that they have you know, plans to buy companies for about $3 billion a year over the next few years. So and they have that firepower. But when you look back and see, for example, Braintree they acquired. Now the head of Braintree at the time is part of the executive team of PayPal, so they really take care of the companies and have the experience that's similar to what Antoine was talking about. You know, Braintree has grown tremendously since it's joined PayPal, and retained some of its culture and its brand name and so on. So I think what can you do other than just look at their history and look people in the eye and sort of and assure that you share a vision, basically.
Yeah, it's really interesting. Sonali, you have a very a great perspective on this. You've seen a huge number of these deals. What, in your mind, are the big risks of these type of M&As or acquisitions, and what should founders be looking for in an acquirer? You know.
So we were early investors in Braintree, and that was one of the good stories. And I think it's great to have these, you know, very positive stories around us, but it doesn't always work out like that. And as Magnus said very articulately, sometimes it's very simple. You just have to ask the questions and do the diligence. And the same way each of you referenced your VCs and asked those difficult questions, it's not so different. I think you have to do the exact same thing in terms of the acquirer. And there's a lot of information out there. So, you know, we have pattern recognition. We know certain acquirers who are just difficult once they buy, and so, you know, we share that data with our companies, and most VCs have that. But here are some of the signals that we've seen. The first is that completion from LOI to deal. There's a lot of companies that like to play and that like to dig, but actually if you do the math, they see there's a lot of LOI activity. It doesn't get there. The second thing actually, which is very technical, but it's very telling, is escrows. So escrows is what you put sort of to give later to the shareholders or to the management team of the company that you buy based on a whole bunch of conditions. And if actually they have a history of not releasing the escrow or actually making claims, which is, oh, you didn't tell me that your blinds were black, or you didn't tell me that you have lunch on Fridays, and I'm not kidding, well, I am, but you get the point, then you know that actually they're litigious and actually they're looking to sort of get a discounted value. But I think it's a lot to do with who is sponsoring the acquisition. You both here and you sat with the leaders of these very large organizations who were personally motivated and motivated you. And you can tell when it's not the case. You can tell when it's a subsidiary of a subsidiary and they're really trying to figure out the synergies. And actually, it's an experiment versus very core to their roadmap. And when the math, when you do that in terms of the acquisition price, the level of bargaining, the level of sort of decisiveness, these are all signals around the leader wants to do this, this is core, and plus or minus a few percentage points, this is going to happen, versus how can I shave off another $500,000 or a few $100,000 or a couple of million. You can tell in terms of the demeanor and the type of dialogue. So there's a lot of data out there. Ask the tough questions and watch out. And the one thing I'll say is, although the VCs are right there behind you and your board is behind you, once you've sold, you're on your own. And so really, I mean, we're out. So this is where incentives are not as aligned. So you really need to make sure that you ask the tough questions because you got to look after your team.
Is there a risk as well that it's just a huge waste of time? I mean, you mentioned companies that just like to have a little dig around but aren't really that serious. Is there an issue that you spend a year talking to some acquirer and then the whole thing collapses and it's massively demoralizing? Have you seen that?
I wish I could say that never happened to me. All my companies get sold like this. So sadly, it's not the case. And actually, it's one of these Groundhog Day conversations you end up having with the management team, where often you say, it's up to you because ultimately it's your company. If you sell, then we're sellers. If you want to stay, we'll support you. And we really do say that because at the end, if the founder's head is not it, just absolutely no point being at the same table. But at the end, the reality is it's very dangerous. So when founders say, what's the big deal? I'll just have a look. I'll have a few conversations. There's a phrase in venture capital which is they've already bought the boat. They get fully pregnant. They think they're going to sell in their head. And it's not always the case, but there is a risk where you won the deal for whatever reason you think it's going to. There are good reasons to do these deals, and it doesn't happen. And it can be emotionally exhausting. It can sap the morale. It can literally derail you for months, if not years. And you make the wrong decisions because you're making the decisions in a different context. So I think, yes, it is very dangerous, but it's also a very tricky decision where if you have a serious buyer knocking on your door and you think it's a good time for all the right reasons, do you take that interest? Do you not? So it's not obvious. There's never an obvious answer.
Yeah. Am I right in thinking, Antoine, that one of your conditions of the Snap deal was that it was all done in 3 weeks? For this very reason.
Yeah, and we were discussing just this with Magnus and Sonali right before. I think one of the best advice we got when we started discussing with Evan came from Peter Fenton and Jean, who are our board members. And they told me, you should think of the conditions of a discussion before the discussion happens. And it's fine to say, I don't want to discuss now. It's also fine to say, okay, why would I not discuss if this condition, and this condition are respected? Because it's also part of the entrepreneur's journey to know how to react to these situations, to learn about these discussions, how they can play out. And so that's what we did. I sent a text message to Evan saying, no strings attached. If we are to discuss, I want to make sure that you're discussing around this, and this. And it's fine if it's not the case. Maybe we'll talk in a year from now. Maybe things will change. But today, we're only ready to discuss within this frame. He sent me a text back in 10 minutes and was here a day later. And we're doing mock-ups of what the product could look like based on the terms. So when we started discussing, I knew that it would end well. One of these conditions was whether we do it together or we remain independent and do it on our own. I want to stay focused. I want my team to stay focused. So discussions can only take 3 weeks. what we know how to do is on the App Store. You've seen it. You've seen me for a year. This is the due diligence of our tech. So let us move fast and potentially let's discuss if you're up to it.
As Sonali was talking about knowing which acquirers are good, you know, your investors can help you know which investors are good and which aren't. But Magnus and Antoine, you've both talked about really like looking the acquirer in the eye, I suppose, is the kind of takeaway for how you get a feel for whether it's going to be a good acquisition or not. In the end, you meet the people and you trust them, but you take it on faith. It's a kind of gentleman's agreement. I was wondering if for the audience here, you could maybe elaborate on really how you do that due diligence, not necessarily financial due diligence, but sort of tips for that to flesh out that idea of looking them in the eye and feeling that they really understand you.
Well, I know it is very tricky and almost unreal in a way when you sit in a situation like, you know, in the end we ended up being acquired for $2.2 billion, you know, and I could hardly count that number, you know, when I sort of, you just sit and try to figure out, you know, who are these guys and what's going to happen. But, you know, in our case, we had several years of on and off partnerships, trying to do things together, failing, but still seeing it should work, but it didn't for whatever reason. And so we didn't know it. It was not like we were brand new to each other. But I think, so for me, I think the most important part was probably in the end, if you know, was talking to the CEO of PayPal, and he asked me questions about, you know, what should I be worried about? You know, culturally, what are the differences that we will meet that will be, you know, make or break, you know, our cooperation over time? And I started talking about very concrete things, like, you know, Swedes go on vacation, you know, and they do that in July. So, and if you don't like that, you know, they sometimes take 4 weeks, you know, and in the US you get 4 weeks as a sabbatical every 5 years, you know, so it's such a different world. But we're still productive, you know, we are less hierarchical than you are in the US, so you have bad projects going on in your company, and so do we. But I think you have more per capita because people are more prone to look to their boss for a decision, whereas in Sweden, people will tell the boss, this is not working, let's scrap this project. So there are lots of things like that where you know, you just have to be aware and feel that you get a sincere response, and that I really felt completely aligned with the team, you know. It's an amazing team, and I just, you have to decide, will I trust them or will I not? And that's what we decided.
Would you agree with that?
Yeah, definitely. One of
Especially the vacation.
Of course. It's a different story, though. I have to close the office so people actually go on vacation at ZENLY. They stay to work otherwise. But just rebounding on Magnus's comments, one thing that ended up convincing me was talking to founders that had been acquired by Snap, one of them being Ba, the CEO of Bitmoji. And he was describing a honeymoon. That's the first word of his response to my first question of how is it going with Snap. It wasn't the case with other companies we had been talking with in the past, and we had read rumors, read things. So that was one of the things that, with our own due diligence, hearing other founders describe their life afterwards, and had they been able to push their vision further, and that's one of the things that helped.
That's really interesting. The way these kind of deals are often spun in the press is with this idea that anytime Europe has a big success story, a big American tech giant comes and just snaps it up. Were you conscious of that when you were doing the deal? Were you worried about that? Did you feel, you know, bad for Europe? What was going through your mind? Do you kind of agree with that take?
Well, you know, I think the U.S. has an enormous advantage in having one more or less homogeneous home market. And that part, of course, is something that we as Europeans have to think about. And you know, I think things like Brexit doesn't exactly help in unifying a market approach. But so yes, I think it's I really believe there is room for big European companies if we stay the course. For us, we were thinking we want to build a global company. How on earth are we going to get into the US? With the competition that was there, and we simply couldn't find a simple way to do that. And with PayPal, we really believe we have that opportunity, of course. So that made us, as founders, as well as thinking about employees, being excited about how we could realize our future vision, basically.
Just adding to that, and I think the story goes both ways, but it's one symbol of maturity of an ecosystem as well, to start seeing acquisitions where products like ours remain fairly autonomous, independent brands, independent products, and continue to develop themselves. We do have a history in Europe of big American companies coming in and buying technologies and putting them in local products. ZENLY, IZETTLE are examples of the opposite, where they continue to run independently, and that's fairly new to the ecosystem. It was one of the symbols that we were happy to be showing to the rest of the ecosystem. It's true, though, that the press did not write that, because people were so formatted with the idea that things would be brought in Snapchat, not being the case in our story. The other thing to it is that I don't think, if we look at the next 10 years, I would expect more acquirers coming from China than from the US. And this is what I'm seeing with my entrepreneur friends. One of the things that happens when you end up selling a company is anytime someone is approached, they call you and ask for help. And I'm sure you've lived with that too. The calls I'm having these days are mostly Chinese acquirers, at least in the Paris ecosystem. Great companies too, but not in the US.
Is that what you're seeing as well, Sonali?
I mean, I think in general what I would say that these decisions to sell or not are very micro decisions and not macro decisions. Each individual company has its own trajectory, and you can't bear the cross of sort of the European ecosystem. But there are some phenomenal examples of very large businesses that have stayed independent because it was the right thing to do on a micro decision basis. Spotify, of course, being the obvious example, which has had a number of people knocking on the door along their particular journey. So I think we're going to see more companies that are independent, and we're going to see more companies that are acquired. I think it's a volume game, and we're just at a sort of certain point in the inflection point of our combined ecosystem across these geographies. The point about the Chinese, it is true that I've never had so much interest from the bat guys, Baidu, Alibaba, Tencent, and others. Before it was all about the US. Europe wasn't on the map, candidly, or not in a big way. And because of sort of the freeze or the chill that is in the US, which is very significant and pronounced at the minute, they are looking more to Europe. I don't think it's obvious or trivial over here, especially around data and data privacy, where you talked about how Snap is excelling in this area, and I think it is very true, versus some of the other big platform companies in terms of what they're going through in terms of data privacy. But the onus on data privacy, if you're a consumer company, and then you have a Chinese company on the cap table, where you're encouraged to use data in China to make some very meaningful predictions around your users, and there are lots of articles you can look at in terms of minority populations. I'm not sure that that's going to be that straightforward in a world where GDPR really matters for European companies. So yes, I think they're looking because they have to. I'm not sure the completion rate is going to be so stellar either, but we'll see.
Yeah, it's really interesting. There's always this kind of trade-off in terms of what's fashionable between an IPO and M&A. Do you see that balance shifting at all, Sonali? Do you see any kind of changes there in Europe? Would you predict any changes?
No, I think the great thing is, I'll say two things. One is the very positive thing about Europe. There are some challenges in terms of different markets and geographies and consumer taste and regulation. Magnus talked about some of it, and I agree Brexit doesn't help. But we do have different exchanges. You have big companies in Frankfurt, you have big companies in Amsterdam, you have big companies in Paris, of course, London. So you have multiple exchanges where now you have sophisticated buyers of tech stocks that help price and build the book. You didn't have that a few years ago, so I think IPO is a real path. But the truth is, it's very difficult to be a public company if you're not big. I think Magnus said it, which is we knew you would be big. You don't get the interest, the coverage, the float if you're not a certain size. I use $1 billion cutoff, which doesn't seem big anymore, but it's not that many companies that are worth $1 billion at a certain point in time. So if you're going to go public, which is a very viable route, I think you do have to be at a certain size and scale, and not all companies have the predictability of business model or the scale to get there, and then M&A ends up being, a very realistic option.
Yeah, that's true. A quick kind of softer question, I suppose, but how do you break the news to your employees?
Well, it was actually quite difficult, and Jacob and I spent a lot of time discussing first, how would they take this if we actually went ahead and signed. But in the end, the only thing you can do, is you call an all-hands meeting, and you try to really sort of radiate the enthusiasm you feel yourself for what this means for the company and for them and for us realizing our vision. And I think it was taken really well by almost all of the company, maybe with the exception of in the financial team, they were getting worried about and then they had worked like dogs to be ready for the IPO. And suddenly you just pulled the rug out under, they were devastated actually, and rightly so. But otherwise, I think the rest of the company were really excited about what it meant in terms of opportunity.
It was probably the hardest thing to do in my whole life, and I've never shared this, but I started explaining it during an all-hands, saying we've decided to join forces with Snapchat, and the team let me run for 10 minutes, thinking I was talking about a partnership. It ended up, they ended up in laughter and applause when they understood that it was an acquisition we were talking about. Snap had, in our case, was the only player that had done what we were looking to do in the 4 years prior to the acquisition. So it was the elder brother, the good example, which made it much easier on our side. It's probably different if it's a company you compete with. In our case, we were just looking up to what they had done and trying to mimic some of the things they were doing.
Yeah. We've got some questions for the board. We've just got 1 minute left. We have one pitch for you for money. Do we need to have revenue or big numbers to get money from you? I think we'll leave that one. We have one about how much founders are involved in the acquisition talks when a VC like ACCEL is a shareholder? As in, like, how prominent a role do you play is the question.
It's the founders having the talk. It's only about the founders. We back the founders, and the great thing about venture capital versus other forms of investors is we're all minority investors. It's really all about what the founder wants to do, or the team of founders. If they decide it's the right thing to do, and of course you support them with all the right questions and the challenges and data and history, but let's make it very clear, it's the founders who make the decision and they recommend. And of course everyone has governance, etc. But in my experience, when the founders have decided that this is the right thing to do, it really is the right thing to support the company.
Fabulous. Well, that's just incredibly interesting and insightful from all three of you. So thank you so much for being here. Can we give a round of applause to our three guests?
Thank you.
Thank you, Michael.